Evolution is the answer to everything that exists, and finance is no exception. Since the financial crisis that happened in 2008, the practices of governments, central banks, and other players in the sector have been called into question. Then in 2009, Bitcoin was born, and this gave the world the tools needed to establish another kind of financial system, one based on decentralized consensus, not centralized fiat, and thus decentralized finance, or DeFi for short, was born. DeFi, or decentralized finance, is an umbrella term for financial services on public blockchains, primarily Ethereum. With DeFi, you can do most of the things that banks support: earn interest, borrow, lend, buy insurance, trade derivatives, trade assets, and more. But it's faster and doesn't require paperwork or a third party. As with crypto generally, DeFi is global, peer-to-peer, pseudonymous, and open to all. DeFi is a collective term for financial products and services that are accessible to anyone who can use Ethereum, basically anyone with an internet connection. With DeFi, the markets are always open and there's no centralized authorities who can block payments or deny you access to anything. Services that were previously slow and at risk of human error are automatic and safer now that they are handled by code that anyone can inspect and scrutinize. DeFi is deeply connected with blockchain, the decentralized immutable public ledger on which Bitcoin is based. That enables all computers or nodes on a network to hold a copy of the history of transactions. The idea is that no single entity has control over or can alter the ledger of transactions. In layman's terms, it can be described as the merger between traditional banking services with blockchain technology. It involves taking traditional elements of the financial system and replacing the middleman with a smart contract. Most of the financial services that could be defined as DeFi can be found on the Ethereum network, which is the second largest cryptocurrency marketplace, which also acts as a platform that allows other blockchain apps to be built on it. So you may be wondering, how does it work? So for DeFi to work, it needs a decentralized infrastructure to run on. This is where the Ethereum blockchain comes into play. The Ethereum blockchain is a DIY platform for decentralized applications, or DApps. Instead of using a neutral third party, DeFi uses an application through blockchain technology, also known as DeFi protocol, to connect users directly. DeFi is open source, meaning that the protocols and apps are theoretically open for users to inspect and to innovate upon. As a result, users can mix and match protocols to unlock unique combinations of opportunities by developing their own DApps. Its products and smart contracts maintain fulfillment of these agreements. Where it is possible to build DeFi apps on other blockchains, Ethereum is the most popular and accessible currently. What can you do with DeFi? DeFi uses cryptocurrencies and smart contracts to provide financial services without the involvement of banks or other intermediaries. With the addition of more DApps, the possibilities of what you can do with DeFi continue to grow. The more popular uses of DeFi include sending money anywhere in the world in little time and affordably, storing money using crypto wallets and earning higher yields than a traditional bank, to borrow and lend on a peer-to-peer level, trade cryptocurrencies anonymously and at any time, trade tokenized versions of investments such as stocks, funds, other financial assets, and non-fungible tokens, and crowdfunding, to list a few. Now, how do people make money in DeFi? There's more than one way that people are attempting to capitalize on the growth of DeFi. One strategy is generating passive income using the Ethereum-based lending apps. Essentially, users lend out their money and generate interest from the loans. Another strategy being used is yield farming, a riskier practice by more advanced traders, in which users scan through a myriad of DeFi tokens in the hope of finding opportunities for larger returns, but it's complicated and can lack transparency. In part 2 of this video, we'll discuss all the integral features of DeFi, such as yield farming, staking, and more. But for now, let's look at what are the benefits of DeFi. Firstly, it's open. You don't need to apply for anything or open an account. You just get access by creating a wallet. Secondly, it's pseudonymous. You don't need to provide your name, email address, or any personal information. Next, it's flexible. You can move your assets anywhere at any time without asking for permission, waiting for long transfers to finish, and paying expensive fees. Fourth, it's fast. Interest rates and rewards are often updated rapidly, as quickly as every 15 seconds, and can be significantly higher than traditional Wall Street. They're transparent. Everyone involved can see the full set of transactions. and many offer higher interest rates. With upsides though, come downsides, such as fluctuating transaction rates on the Ethereum blockchain means that active trading can get very expensive. Depending on which DApps you use and how you use them, your investment could experience a high volatility. This, after all, is new tech. Thirdly, you have to maintain your own records for tax purposes. Regulations can vary from region to region. And lastly, if you forget your password, you can lose your assets since there is no governing body. With that being said, how risky is DeFi? Like all other decentralized blockchain networks trading in cryptocurrencies, DeFi is very risky, especially as you're using a new technology that aims to disrupt an established institution such as a centralized bank. It's even riskier for novices lured by the potential of gains of yield farming and passive income. Ethereum has security and scam prevention guidelines, as there is also broader potential risks. Fraud and crime or hacks and scams continue to be significant issues. About 2.2 billion was outright stolen from DeFi protocols in 2021, according to Chainalysis, which is double from 2020. Many attacks on DeFi exchanges over the past year can be traced back to errors in the smart contracts code governing those protocols, which hackers exploit to steal funds. And there's no backup. Just like your bank account, DeFi and cryptocurrency wallets must be secured with private keys. A private key is a long, unique code known only to the wallet's owner, which is a good thing unless you are prone to losing things, because if you lose your private key, there's no way to recover your funds ever. Looking forward into the future of DeFi. DeFi is still in its infancy stages of its evolution. For starters, it is unregulated, which means the ecosystem is still riddled with infrastructural mishaps, hacks and scams. Current laws were crafted based on the idea of separate financial jurisdictions, each with its own set of laws and rules. DeFi's borderless transaction ability presents essential questions for this type of regulation. Other concerns are system stability, energy requirements, carbon footprint, system upgrades, system maintenance, and hardware failures. Many questions must be answered and advancements made before DeFi becomes 100% safe to use. With that in mind, is anything ever 100% safe? If the trend continues and the DeFi maximalists are right, this is just the beginning of a massive DeFi wave. True believers argue that the advantages of an open and decentralized financial system are simply too compelling to not capture trillions of dollars of value. So, what are your thoughts on DeFi? Do you use any DApps currently? If so, let us know which ones and why. If you enjoyed the video, please be sure to hit that like and subscribe button so not to miss out on more.